Good afternoon, everyone. The MPC reviewed current and evolving macroeconomic and financial conditions and decided to keep the policy rate unchanged at 6% while maintaining a neutral monetary policy stance. This was by a majority of 5-1. The MPC reiterated its commitment to keep headline inflation close to 4%. We expressed concern about the loss of momentum of growth in the early months of 2017-18, especially the persisting weakness in manufacturing. The MPC noted that the implementation of the GST appears to have rendered short-term prospects uncertain, possibly delaying the revival of investment activity, which is already hampered by stressed balance sheets of banks and corporations. On a positive note, however, core industries posted a robust growth of 4.9% in August. The manufacturing PMI moved into expansion zone in August and September. The teething problems linked to the GST may get resolved relatively soon, allowing growth to accelerate in the second half of 2017-18. The outlook for agriculture and allied activities is favorable, and services sector performance has improved markedly, with many indicators pointing to further strengthening in the months ahead. Over the rest of the year, household consumption demand may get a boost from upward salary and allowances revisions by state governments for their civil servants. On the downside, a faster than expected rise in input costs and lack of pricing power may put pressure on corporate margins, thereby affecting value added by industry. Taking into account these factors, the projection of real GVA growth for 2017-18 has been revised down to 6.7% from the August 2017 projection of 7.3%, with the risks evenly balanced. On the other hand, the MPC observed that CPI inflation has risen by around 2 percentage points since our last meeting. These price pressures have coincided with an escalation of global geopolitical uncertainty and heightened volatility in financial markets. Although the domestic food price index looks largely stable, generalized momentum is building on prices of items excluding food, especially emanating from crude oil, some price revisions in the wake of the GST implementation, and the possibility of fiscal slippages. Accordingly, the MPC expects inflation to rise from its current level and range between 4.2 to 4.6% in the second half of this fiscal year, which includes the house rent allowance by the center. Factors that impart upside risks to this trajectory are the implementation of farm loan waivers and salary and allowances, award of the 7th Pay Commission by states, and potential second-round effects on account of that. However, adequate food stocks and effective supply management by the government may keep food inflation under check. The MPC was of the view that recent structural reforms will likely be growth augmenting over the medium to long term by improving the business environment, enhancing transparency, and increasing formalization of the economy. The Reserve Bank continues to work towards the resolution of stressed corporate exposures in bank balance sheets, which should start yielding dividends over the medium term. It reiterated, however, that it is imperative to revive investment activity, which in turn should revive the demand for bank credit by industry. Recapitalizing public sector banks adequately will ensure that credit flows to the productive sectors are not impeded and growth impulse is not restrained. In addition, measures need to be undertaken to support growth and achieve a faster closure of the output gap, including restarting stalled investment projects, particularly in the public sector, enhancing ease of doing business, including by further possible simplification of the GST, and ensure faster rollout of the affordable housing program with time-bound single-window clearances and rationalization of excessively high stamp duties by states. I will shortly turn to my fellow deputy governors to explain the various developmental and regulatory policy measures announced today. But before doing so, I would like to draw attention to two measures which are aimed at improving the reach of financial services. The first one relates to the use of prepaid payment instruments The Reserve Bank had issued guidelines for issuance and operations of prepaid payment instruments in April 2009 in order to foster an orderly development of the PPI ecosystem. It has been decided to rationalize the operational guidelines with a view to encouraging competition and innovation and strengthening safety and security of operations, besides improving customer grievance redressal mechanisms. In line with the vision for payment and settlement systems in the country, the revised framework will pave the way for bringing interoperability into usage of PPIs. Interoperability amongst KYC-compliant PPIs shall be implemented within 6 months. At the same time, it has been reported that banks are discouraging or turning away senior citizens and differently abled persons from availing banking facilities in branches. Notwithstanding the need to push digital transactions and use of ATMs, it is imperative to be sensitive to the requirements of senior citizens and differently abled persons. It has been decided to instruct banks to put in place explicit mechanisms for meeting the needs of such persons so that they do not feel marginalized. Ombudsmen are also being advised to pay heed to complaints in this context. Thank you. I'll now request Deputy Governor Viral Acharya.
Thank you, Governor, and good afternoon, everyone. Household inflation expectations have been steadily getting anchored down as they are adapting to the realized inflation trajectory. However, these expectations still remain relatively high and are also manifested in the continuing high level of rural and non-rural wage growth. Recent headline inflation prints have risen substantially from historic lows and in a broad-based manner. In addition, as the Governor pointed out, oil price risk and global market volatility have risen materially. In such a scenario, it is important for the Reserve Bank to persist steadfastly with its objective of keeping medium-term inflation within a striking distance of the target rate of 4%. The recent loss of momentum in growth seems to have energized quite a lively debate. It is too early, however, in my view, and real-time activity indicators do not yet paint a clear picture to be able to separate the transient component of this one-quarter loss of momentum from the gradual decline in overall growth that has taken hold since the Q1 of 2016-17. The longer-term trend is best explained by the deleveraging underway in the heavily indebted parts of the corporate sector and in poor credit growth at public sector banks, given they have